The textbook says it's simple. Dollar up, silver down. Dollar down, silver up. For decades, traders built entire strategies on this inverse correlation between DXY and silver prices. But on December 12, 2025, something broke. Silver hit $64.47 per ounce, while DXY held steady at $98.39. A market behavior that shouldn't exist according to conventional wisdom. This decoupling reveals a dangerous trap. Investors relying solely on the DXY-Silver inverse relationship are missing the bigger picture and potentially sitting on the wrong side of a historic shift in the silver market. Silver and the US dollar index share what appears to be a straightforward inverse relationship. When DXY strengthens, silver typically weakens. When DXY falls, silver rallies. This correlation exists for a fundamental reason. Silver is priced in US dollars globally. As the dollar strengthens against major currencies, the euro, 57.6% of DXY, Japanese yen, 13.6%, British pound, 11.9%, Canadian dollar, 9.1%, Swedish krona, 4.2%, and Swiss franc, 3.6%, silver becomes more expensive for foreign buyers, reducing demand and pressuring prices lower. Historical data supports this relationship. According to a market analysis, the 60-day rolling correlation between precious metals and DXY has consistently shown negative readings. In 2022, when the Federal Reserve's aggressive interest rate hikes pushed DXY to two-decade highs near 114.80, silver lost significant ground as USD-denominated prices climbed. During that period, the correlation coefficient between silver and DXY was observed at approximately negative 73% to negative 95% across various time intervals. The mechanics are clear. A stronger dollar increases purchasing power for Americans buying silver, but simultaneously makes it prohibitively expensive for holders of euros, yen, or pounds. This creates natural selling pressure from international markets, which comprise a significant portion of silver demand. Conversely, when DXY weakened in early 2025, falling approximately 10.8% in the first half, gold and silver hit new record highs as international buyers rushed in while the metal was on sale in their local currency. However, 2024 and 2025 witnessed something extraordinary. Both gold and the dollar demonstrated significant strength simultaneously. This unconventional market behavior challenges the foundational assumption traders have relied upon for decades. As of December 12, 2025, DXY traded at $98.39, showing relative stability with only a 0.05% daily increase. Yet silver surged to record territory above $63 per ounce, gaining approximately 102% year-to-date, according to Washington Post reporting. This decoupling isn't random. It reflects structural changes in the silver market that transcend currency relationships. Several critical factors are driving this breakdown of traditional correlations. Industrial demand surge. Silver's industrial applications have exploded, creating inelastic demand that persists regardless of dollar strength. In 2025, photovoltaic solar panels consumed an estimated 234 million ounces, up 18% year-over-year. Electric vehicle production used approximately 78 million ounces, up 22%. Most significantly, data center infrastructure supporting the AI boom consumed roughly 41 million ounces, up 37% from 2024. These industries cannot easily substitute away from silver. They need the metal regardless of its dollar-denominated price. Supply deficit reality. The Silver Institute's 2025 World Silver Survey projected a deficit of 117 to 206 million ounces for the year, the fifth consecutive annual deficit. This cumulative shortfall now exceeds 600 million ounces since 2021, yet mine production remains flat at approximately 813 million ounces annually. When genuine physical scarcity exists, pricing mechanisms shift from currency-driven to supply-constrained. COMEX inventory crisis. The most dramatic signal came from COMEX registered silver inventories. In early December 2025, over 47.6 million ounces were claimed for delivery in just 4 trading days, representing more than 60% of COMEX's total registered inventory. By December 8th, registered stocks had fallen to approximately 28 to 33 million ounces, the lowest levels in over 15 years. When physical backing becomes this tight, traditional currency correlations become secondary to delivery mechanics. Institutional positioning shift. JP Morgan's dramatic reversal represents perhaps the clearest signal of structural change. Between June and October 2025, the bank reportedly closed its entire 200 million ounce short position in paper silver contracts and flipped to a net long stance, accumulating approximately 750 million ounces of physical silver, the largest stockpile in history, equivalent to nearly a year's global mine production. When Wall Street's largest commodity trading desks reverse positions like this, it signals that fundamental market dynamics have shifted. Traditional analysis suggests that Federal Reserve rate cuts should weaken the dollar and boost silver prices. The Fed delivered a quarter-point cut on December 11, 2025, bringing the federal funds rate to 3.50% to 3.75%, and signaled potentially one additional cut in 2026. However, the dollar's response was muted, and silver's rally appeared disconnected from this monetary policy shift. This reveals another layer of the correlation trap. Real interest rates matter more than nominal rates. When the Fed cuts rates but inflation expectations remain elevated, real yields can stay positive or only slightly negative. As of mid-December 2025, real yields on 10-year treasuries minus expected inflation stood at approximately negative 0.3%. Barely negative. Historically, silver performs best when real yields are deeply negative, averaging gains around 28% per year in such environments. The current shallow negative real yield environment creates conflicting signals that break simple DXY-Silver correlations. Additionally, the Fed's Treasury bill purchase program, injecting $40 billion monthly to support liquidity, creates non-traditional monetary accommodation without the full quantitative easing stigma. This targeted approach affects precious metals differently than broad QE programs, further complicating correlation-based trading strategies. The gold-to-silver ratio currently sits around 68 to 80, meaning it takes that many ounces of silver to equal 1 ounce of gold. Historical analysis shows this ratio typically oscillates between 50 to 1 and 80 to 1 during normal market conditions. At current levels, the ratio suggests silver may be undervalued relative to gold, but this too can be a trap. In 2022, when DXY peaked near 114, the gold-silver ratio spiked to approximately 95.8 in late August and early September as both metals declined, but silver fell faster. Conversely, during periods of extreme stress like March 2020's COVID panic, the ratio exploded to 125 to 1, as gold surged while silver markets seized up with physical shortages and trading disruptions. The current ratio, around 68 to 80, indicates relative balance. But here's the critical insight. When the ratio compresses dramatically, dropping below 50 to 1, it typically signals silver is overextended and due for mean reversion. When it expands above 80 to 1, silver is historically undervalued and positions for violent rallies. The 40% silver rallies of 300 to 400% historically followed ratio readings above 80. However, investors chasing the gold-silver ratio as a signal must recognize it reflects relative performance, not absolute direction. Both metals can fall while the ratio changes, or both can rise. The ratio doesn't tell you when to buy silver. It tells you when silver might outperform or underperform gold, which is fundamentally different from directional price prediction. This dual nature creates what analysts call industrial monetary beta. Silver responds to both industrial economic growth and monetary debasement fears. When DXY strengthens due to industrial economic strength in the US, silver should theoretically fall on currency effects but rise on industrial demand. When DXY weakens due to monetary policy concerns, silver should rise on both currency effects and safe haven demand. This dual beta amplifies silver's volatility, but also creates periods of decoupling. Tesla, Samsung, and other major manufacturers require silver for batteries, electronics, and solar applications, regardless of DXY levels. When this industrial demand intersects with monetary concerns about dollar debasement, silver can rally violently even as DXY holds steady or strengthens moderately. Bank of America released a $65 12-month target on December 9, 2025, citing narrowing real yields, increasing ETF inflows, and persistent supply deficits. JP Morgan's forecasts suggest silver could reach $39 per ounce by end of 2025 in conservative scenarios, with more aggressive projections pointing to $45 to $55 by 2028 to 2029 if industrial demand continues accelerating. Another critical factor in the correlation trap is geographic price dislocations. On December 12, 2025, Shanghai spot premiums to London spot reached approximately 0.2%, relatively modest. However, in late November 2025, premiums briefly hit 5%, indicating intense Asian physical demand that overwhelmed currency-based pricing. When Shanghai trades at significant premiums to London, it signals Chinese buyers are willing to pay above international prices to secure physical metal. This geographic arbitrage creates pricing inefficiencies that break DXY correlations because Chinese buyers price silver in yuan, not dollars. The currency crosses, USD-CNY, become more important than DXY itself. Similarly, COMEX futures trading at premiums to London spot, approximately 40 cents in mid-December, indicates delivery stress in North America. This backwardation, spot above futures, traditionally signals immediate demand outpacing future expectations, another break from currency-driven pricing. Perhaps the most dangerous aspect of the correlation trap is the leverage between paper contracts and physical metal. As of December 2025, COMEX open interest reportedly reached 244% of vaulted silver, meaning 18.3 paper contracts exist for each ounce of registered physical silver. This creates extreme delivery risk when contract holders demand physical settlement. When investors trade silver based on DXY correlations, they're typically trading paper instruments, futures, ETFs, or mining stocks. These respond to currency movements because they're financial instruments first, commodity exposure second. However, when physical delivery stress emerges, as seen in December 2025's 60% registered inventory drain in 4 days, paper prices can decouple violently from physical premiums. During the 2020 COVID disruptions, physical silver coins traded at 60% premiums over spot prices, while paper silver contracts reflected only modest gains. Investors relying on DXY correlations to trade paper silver missed the physical market reality entirely. The inverse relationship between DXY and silver is not a myth. It exists and functions as described under normal market conditions. When the dollar strengthens against major currencies, silver typically faces downward pressure. When the dollar weakens, silver usually rallies. Historical data confirms this with correlation coefficients ranging from -73% to -95% across various time frames. However, normal market conditions is the critical qualifier. The silver market in late 2025 does not reflect normal conditions. 5 consecutive years of supply deficits totaling over 600 million ounces, accelerating industrial demand from irreplaceable applications, COMEX registered inventories at 15-year lows, and major institutional positioning shifts have created a market environment where traditional correlations break down. Level 1. The simple inverse. Traders who believe dollar up equals silver down will be caught wrong-footed when industrial demand or supply constraints override currency effects. December 12, 2025's price action, silver at $64.47, while DXY held 98.39, demonstrates this clearly. Level 2. The ratio game. Investors who chase gold-silver ratio signals without understanding absolute supply-demand fundamentals can miss major directional moves. The ratio can normalize even as both metals rally or fall together. Level 3. The paper physical disconnect. The most dangerous trap involves trading paper silver based on DXY correlations, while physical markets experience delivery stress. When COMEX registered inventories approach exhaustion, paper contracts may settle in cash while physical premiums explode, a scenario that DXY correlations cannot predict or protect against. Rather than relying solely on DXY correlations, sophisticated silver investors track multiple indicators. COMEX registered inventories, currently around 28 to 33 million ounces, down from 48 million in early December 2025. Levels below 20 million ounces historically precede delivery crises. Silver lease rates. As of December 12th, approximately 38% annualized for 1-month duration. Readings above 50% suggest extreme physical tightness, seen only 3 times in 20 years: September 2008, March 2020, October 2025. Backwardation spread. Current spread approximately 40 cents, with spot around $63.74 and March futures at $64.14. Sustained backwardation for more than 5 trading days has historically preceded significant price movements within 30 days. Shanghai premiums, currently 0.2% above London spot, relatively modest. Premiums above 2% sustained for a week signal stress. Late November's 5% premiums indicated extreme Asian demand. Industrial demand data. Monthly reporting from solar manufacturers, EV producers, and data center builders provides forward-looking demand indicators independent of currency movements. ETF flows. iShares Silver Trust holdings jumped approximately 590 tons in early December 2025, reaching the highest level since early 2021. Sustained institutional inflows override short-term currency effect. Conservative forecasts for 2026 project silver reaching $70 to $75 by March, before consolidating between $65 to $80. This measured rally scenario, assigned approximately 50% probability by analysts, assumes December contract expiration forces some short covering, profit-taking creates January pullbacks, and renewed ETF inflows drive the next leg higher. More aggressive scenarios, given roughly 30% probability, suggest silver could reach $85 to $95 by June 2026 if COMEX registered inventory falls below 10 million ounces and major industrial buyers attempt to secure multi-year supply. This parabolic squeeze would be confirmed by silver lease rates exceeding 50% annualized and backwardation expanding beyond 90 days across the futures curve. Bearish scenarios, around 20% probability, envision silver peaking between $68 to $72 in the next 30 days before correcting to $52 to $58 by Q2 2026. This correction and reset would likely result from disappointing industrial demand data from China or Federal Reserve hawkish pivots that turn real yields positive again. Notably, none of these scenarios depend primarily on DXY direction. The dollar could strengthen moderately while silver rallies on supply constraints, or weaken while silver corrects on demand disappointment. The correlation exists, but no longer dominate. The 1980 Hunt Brothers silver squeeze saw prices hit approximately $49 per ounce, despite a relatively strong dollar environment. COMEX changed rules overnight to allow cash settlement, crashing prices, but the squeeze itself demonstrated that physical supply constraints override currency correlations. The 2011 silver peak near $50 per ounce occurred during a period when DXY was relatively weak, around 72 to 75, appearing to confirm the inverse correlation. However, the rally was driven more by retail investment mania and ETF inflows than dollar weakness. When that speculative demand evaporated, silver crashed to $26 within months, even as DXY remained relatively weak. The 2020 COVID crisis initially saw both DXY and gold rally simultaneously to multi-year highs, breaking the expected inverse relationship. Geopolitical tensions, including Russia-Ukraine and Middle East conflicts, drove safe haven demand for both assets regardless of their typical correlation. Silver followed with a lag, ultimately rallying as physical shortages emerged. These historical examples demonstrate that extreme market conditions, whether supply squeezes, speculative manias, or crisis-driven safe haven flows, consistently override normal currency correlations. JP Morgan's reported shift from 200 million ounce net short to 750 million ounce net long physical position represents the clearest institutional signal. This wasn't a short-term trade based on DXY forecasts. It was a multi-year strategic accumulation reflecting fundamental supply-demand analysis. When major banks position for structural shortage, regardless of currency movements, retail investors relying on DXY correlations are trading against smarter money with better information and longer time horizons. Bank of America, Goldman Sachs, and other institutions publishing 65 to 70-plus silver targets for 2026 consistently cite supply deficits and industrial demand growth, not dollar weakness, as primary drivers. Their analysis assumes DXY remains in the 96 to 100 range, meaning they expect silver to rally even with a relatively stable dollar. For active traders, the correlation trap creates both risks and opportunities. Risk. Shorting silver based on DXY strength signals could result in devastating losses if physical delivery stress triggers a squeeze. The inverse correlation might work 70 to 80% of the time, but the 20 to 30% of instances when it fails can produce losses exceeding all prior gains. Opportunity. Recognizing when industrial demand or supply constraints dominate allows traders to position for silver rallies independent of DXY direction. Monitoring COMEX inventories, lease rates, and backwardation provides earlier signals than currency charts. Hedging. Rather than trading silver directionally based on DXY, sophisticated investors might hold physical silver as a long-term supply shortage play while tactically trading paper silver against short-term DXY moves. This separates strategic positioning from tactical timing. Ultimately, the DXY measures the dollar's value against other fiat currencies, euros, yen, pounds, and francs. When DXY strengthens, it means the dollar is losing value slower than other currencies, not that the dollar is gaining absolute value. Against real assets, like silver, all fiat currencies have been losing value consistently. Since 2000, gold has risen from approximately $915, while DXY increased 45%. Yet gold has also increased 150%. DXY is flat over 22 years, while gold is up more than 7x. The inverse correlation between DXY and precious metals exists in the short term, but disappears over longer periods as fiat debasement dominates. Silver's dual nature as both industrial commodity and monetary metal positions it uniquely for the 2020s. Industrial demand from solar, EVs, and AI infrastructure provides a floor under prices that didn't exist in previous decades. Monetary demand from investors seeking inflation hedges provides the ceiling-breaking potential during supply squeezes. The DXY-Silver inverse correlation is a useful short-term trading tool under normal market conditions. It reflects real mechanisms, currency-driven purchasing power affecting international demand. However, treating this correlation as predictive causation creates a dangerous trap. Silver prices in late 2025 are being driven primarily by 5 consecutive years of supply deficits, accelerating industrial demand from solar, EVs, and AI infrastructure. COMEX registered inventory approaching critically low levels, major institutional positioning shifts from short to long, physical delivery stress creating paper-physical price dislocations. These fundamental factors dominate currency effects. DXY can provide tactical entry and exit signals, but supply-demand fundamentals determine the strategic direction. Investors who understand this distinction, using DXY correlations as one input among many rather than the primary decision driver, will navigate the 2026 silver market successfully. Those who rely exclusively on dollar movements will repeatedly be caught on the wrong side when the correlation breaks. The correlation trap isn't that the inverse relationship doesn't exist. It's that investors believe it's always reliable. In a market experiencing structural shortage, institutional positioning shifts, and physical delivery stress, currency correlations become secondary. Recognizing when fundamentals override correlations is the difference between trading textbook theory and trading market reality.